Hi, good morning, everyone. Welcome to our Phillip Securities Research morning call for today. We have a few stock counter updates, including an initiation for Grab, results update for JP Morgan as well as Wells Fargo. We also have a summary of our second quarter US Treasury and stock picks, which was held last Thursday. Also, our usual technical analysis and Singapore Weekly. So this is our disclaimer slide. The information provided is solely for educational purposes and should not be considered as financial advice. So next up will be the initiation on Grab. This was initiated by Helena, but she's on leave today, so Glenn will be covering on her behalf. Yeah, over to you, Glenn. Thanks.
Hey, thanks, Zane. Yep. Oh, sorry. Okay, we just start off first with Grab. Yeah, so Grab, I think everyone is quite familiar with Grab, what they do. I'll just be quick on the background. It's a Singapore-based multinational technology company, but they did list in the US. So it only has a presence in Southeast Asia. It's the leading, we call it the super app. Market cap is currently at 14 billion US dollars. So it has three main arms now. The two biggest ones, of course, I think most people are familiar with would be their ride-hailing and their food delivery. And now they have expanded into the digital finance or digital banking sector, which with GXS. Their services also spans across 8 countries, the biggest being Malaysia, Indonesia, and Singapore. And the rest will be the rest of the ASEAN countries. I think the next biggest would be Thailand as well. So now moving on to the next slide. Yep. So we have three investment merits. The first one being that we believe that there is strong growth momentum in their on-demand services. So their on-demand services, this refers to their mobility and deliveries. So mobility is their ride-hailing, and deliveries is their like food delivery, Grab delivery, so on and so forth. And it has expanded quite significantly since 2020. So since 2020 to 2024, it has expanded by sixfold from 0.4 billion US dollars to 2.5 billion US dollars. And the monthly transacting user or MTU growth is also quite healthy at around 16%. We believe that there's sustained demand for mainly from the deepening ecosystem. And also, if you look at their Grab Unlimited, which I think, if you use Grab, you will get pushed it quite often. It's a bit like their premium service where, you can get discounts on certain things. Yeah, it's also at an all-time high, and it contributes to around 35% of deliveries of deliveries GMV. And we believe that as more people opt into this subscription service, and they will rely more on the whole ecosystem and the platform for their daily needs, which means basically a stickier user base as well as stronger customer retention, and also this will all flow into their a more recurring revenue stream. Secondly is that they have expanded into this financial services and this digital banking sector with GXS. So revenue has also increased from around negative 10 million. So they were in 2020, they were I think trying to expand when they first started to 253 million in FY24. And their main purpose of this digital bank is not to compete with the local banks like DBS or UOB or OCBC, but it's more to serve the underbanked population. And they do have the background they have the proper tools and the data for that, because with the data that they have from their drivers, from the food delivery riders, right? These are mainly the underbanked populations in the world. Sorry, in the countries that they do have presence in. And it's a significant market. As we estimate that around 70% of adults, at least not in Singapore but in ASEAN, have limited access to financial services. So the two factors that we look at for the banking sector is that their loan platform and their loan portfolio has grown by 64% year on year in FY24, and also their deposits have grown to reach 1.3 billion US dollars in FY24, while their NPL or non-performing ratio has maintained quite stable at around 2%. For the last one, the last investment merit which we have, next slide, would be that they are, and this is probably the most important one, which is that they are moving towards profitability. So before that, Grab was really performing like just any other new tech company where they just, they look at the revenue numbers, and as long as that is growing, they don't really care about the rest, right? You just spend at all costs. You grow at all costs, right? But currently what's happening is that they have finally managed to have positive net income for the last 2 quarters, and the adjusted EBITDA has also reached around 97 million year on year, which is a 177% growth year on year. And I think the main challenge for Grab is to transition from a subsidy-driven growth where they were just expanding at all costs to a more organic one. However, we have seen that recent operational enhancements have started to yield some results, and they are now guiding for an improved EBITDA margin of around 9 to 10% as compared to 8.4% previously. So that's the three. We also do anticipate that this profitability will continue, and not just continue, but continue to improve moving into the next few years. So that's for the investment merits. I'll now move on to the next slide. Yeah, there are still, of course, some risks that we see and vision with Grab. The main one being that the incentives are still quite high. So, their fourth quarter incentives did reach 512 million, and this consists of 10.1% of their GMV. So, in order to grow, they will still need to give out incentives, but I think they're giving out less and less as they move forward, and that's the aim, to try to reach better profitability. There's also some regulatory risks. They are in so many countries, so they do have to be, they have to know the regulations, of all of these countries, and abide by all of them. Not just, let's say I'm only in Singapore, I have to listen to what the government says in Singapore. There are also platform reliability and security. Again, with such a big company, they will need to invest quite a bit into making sure that their platform is secure, and there won't be any leaks of customer data, and so on and so forth. The last two is customer safety incidents, as well as the complexity of being such a diverse and big app. Okay, now moving on to the next slide. Yep, so we do initiate coverage with a buy call, as well as with a target price of $5.80. So that's for Grab. I'll now just go straight to the US results. Yeah, so two banks released their results, and I think they were the first US, the big US companies that were to release their results, in these volatile times, and especially after Trump announced all the tariffs and all the revision of tariffs and whatever. Yeah, so they were the first company, so all eyes were on the banks. We also start off with JP Morgan, which was the first, and then after that with Wells Fargo. So for JP Morgan, the first quarter earnings did rise by 9% year on year, so that is a good sign. But then again, it was still below our estimates, with the first quarter earnings at only 22% of our forecast. I think the main positive for JP Morgan is that their non-interest income did continue to support their growth. So we see, all lines of non-interest income, such as the principal transactions, asset management fees, as well as investment banking fees, did improve, and this contributed to non-interest income growing by 17% year on year, and now contributing to 49% of their total net revenue, as compared to 45% a year ago. The second positive is that their net interest income, or NII, did inch up. So for JP Morgan, they were able to lower their funding costs faster than the asset yields went down. So hence, they managed to actually increase their interest rate spread by 6%, and 6 basis points, sorry, and their net interest income inched up by 1% year on year. I mean, it's not very exciting, but at least we saw net interest income move up a little bit. This really did come from the markets NII. So if you exclude that markets NII, it was down by 2% due to the lower rates, deposit margin compression, as well as lower deposit balances in their consumer and community banking. Loans growth was also, a bit sluggish, is only coming in at around 2%, mainly from the credit card as well as their wholesale segments. As for the negatives, the main negative is that their provisions was up 75% year on year. So it might seem a bit scary, you know, that, oh wow, their provisions went up. But then again, take note that this is only the first quarter results. So this is, you know, as of end of March, right? So it was even before whatever sort of Trump announced. But the main reason for the increase in provisions is not that there was higher bad debt, you know, higher allowances. It's that they did build up more of their net reserves, right? So they really anticipated, you know, as near the end of March that something was going to happen, and you know they built up quite a bit of reserves. So they had 973 million of net reserve built as compared to a release of 72 million the year ago, right? So this was really what in their words was changes in the weighted average macroeconomic outlook. So they did forecast that something like this was going to happen, hence they built up more reserves to you know try to tide through the next few rough quarters that I think they anticipate that it might come in. Net charge-offs was a little bit higher, but mainly due to the increase in net credit card net charge-off rate. Last negative is that the expenses did rise again, mainly coming from the higher compensation, higher brokerage, as well as expenses, as well as higher marketing expense. For the outlook, you know, they did raise their guidance by a little bit from 94 for net interest income from 94 billion to 94.5 billion. And the increase will mainly come from higher markets net interest income. So they now expect 3 rate cuts, you know, in their modeling instead of 1 when they were in the previous quarter. But however, they did say that, you know, this is not a reliable kind of forecast because it changes very quickly and all the time, right? On the expenses side, is unchanged at 95 billion. And so the tariffs wise, you know, the trade war will not have a direct impact on the US banks, but we believe that there will be indirect impact for the banks in general. So it's very similar as for Wells Fargo and you know all the other the big US banks out there. Mainly it's the slower loan growth as a lot of consumers and businesses hold back due to uncertainties surrounding costs, higher provisions, which we could see come in, you know, from higher defaults as well as higher unemployment, and more rate cuts, which would impact their net interest margins and net interest income. So we do maintain and accumulate with a lower target price of $252. And we like JP Morgan mainly because it is the largest bank in the United States. It's also the most diversified. In sense of geographical wise, they have presence in a lot of countries, right? Not just there's not just in the US. So they have presence heavily in Asia as well. And also, you know, if you look at their revenue streams, it's also quite diversified in the sense that they don't solely rely on net interest income. They also have huge investment banking, asset management, wealth management kind of portfolio. So they are very diversified, and they also have the highest of if you look at net amount, that they have the highest capital amongst all the large US banks. So they are, in a sense, they are the most stable for the US banks. So that's why we like JP Morgan. Now moving on to the next slide, we have Wells Fargo. Yeah, so Wells Fargo, next slide please, yeah. Earnings was up 6%, but also similarly with JP Morgan, it was also below our estimates, with the first quarter earnings coming in at 21% of our forecast. I mean, if you have followed the recent news on Wells Fargo, you could see that you know their shares did take a hit, mainly because their net interest income declined by 6% year on year. So I'll just touch on the negative first, which is their net interest income has continued to decline. So unlike JP Morgan, they weren't able to like shift a lot, like lower their costs faster than their asset use lowered. Hence, you know, we saw this 6% decline in net interest income, and it was really coming from the lower interest rates on their floating rate assets, deposit mix, as well as pricing changes and lower loan balances. So their loans growth fell instead of, you know, it didn't move up, and mainly from declines in their CRE, commercial real estate, as well as the residential mortgage loans. Now moving to the positives, which there are some positives, which is the investment advisory as well as the IB fees has continued to grow, and this is what supported their non-interest income, which was actually flat if you look at it in a whole, because this increases were offset by lower net gains from trading activities as well as lower net equity gains and higher loss of debt securities. The other two non-interest segments, which is card fees and deposit lending and lending related fees, were relatively unchanged. But another positive is that their expenses has been controlled. So expenses went down for first quarter 2025, mainly from a decline in operating losses as well as the lower FDIC special assessment. And last but not least, the CRE net charge-offs did improve. So the net charge-offs fell by 12%, mainly driven by this lower commercial real estate, predominantly in the office portfolio. And this might also explain why their loans declined, is because they let go some of these CRE office loans, which is why their net charge-offs also improved. You look at their allowances wise, it has declined across most loan portfolios, and as a result, their provisions for credit losses did fall by 1% year on year. As for the outlook, we believe that they will be having a slightly rough year for 2025, right? If you look at their net, they did maintain their net interest income outlook and their expense outlook, so they didn't move it much. But they also said that that a lot of the factors that is determining this net interest income outlook are still uncertain due to the current economic environment. So we might not be seeing what they said come true, but they also did say that to look at the lower end of their guidance of 1 to 3%. So the net interest income will probably only improve by 1% or even less than that. For expenses wise, it's coming in at around 54.2 billion. Again, with the Trump's tariffs, it's very similar to JP Morgan, right? The lowest loans growth, higher provisions. But for Wells Fargo, we do see maybe a slower fee income and non-interest income growth, and this will sort of dampen their way of trying to diversify into non-interest income. We do upgrade to a buy, mainly due to the recent share price performance with a lower target price of $75. And we expect a slow and stable year for Wells Fargo, with the net interest income expected to turn around in FY25 and lower expenses from their efficiency initiatives. However, the headwinds will really come from their macroeconomic factors, which will impact the growth of their non-interest income, particularly in their investment banking as well as trading activities, and possibly higher provisions. So that's all for Wells Fargo. I'll now move on to the recap of the US SSP that we had last week. So yeah, we just jump straight to the sector teams. Yeah, I just spoke a lot about the banks, so I'll be quite quick on this, about the US banks. The main thing is, can the fundamentals hold strong for the US banks? Yeah, so what we have seen recently, so this is actually the fourth quarter's data, is that the net interest income and net interest margins have continued to rise, right? And despite the rate cuts, and this is really because the decline in the cost of funds is faster than the decline in the asset yields. Hence, the banks were able to sort of take advantage of that, and inch up the net interest margins as well as the net interest income. Now, moving on to the next slide. Yeah. The loans growth has been very sluggish, after a recovery post-COVID. But, it's around low single digit, and we believe that, the tariffs might actually hamper this further growth in loans. So we could see it even slowing down to maybe 1% or lesser in the coming year. So this will actually this will be a headwind for the US banking sector. Now moving on to the next slide. Yeah. So another big question that we get for the banks is, will they be able to tide through yet another rough time? They went through COVID. Now they have this I would say self-inflicted problem, right, that they have. So the main ratio that we look at will be the reserve coverage ratio, and we can see that it's much higher than the pre-pandemic level. So this might be a lesson that the banks have actually learned previously, where now they are keeping a lot more reserves. And also, from JP Morgan's recent the first quarter results, we can see that they were actually building up on their reserves, right? Just to prepare themselves for a tougher time or volatile times ahead. So we believe that they will have the capacity to tide through any volatility in the future. So overall, for the US banks, we believe that they will be able to continue to grow. It will be very stable. It will be a slower year for them for sure, as the non-interest income falls off. Yeah. So maybe I'll just quickly talk on, I was talking about JP Morgan and Wells Fargo, and maybe just to answer that question, I would say the better valuation for now would be Wells Fargo. But if you want to have a more stable bank, then that would be JP Morgan, because they are more positioned, right? Where in a sense they have more diversification into the different geographies, right? Not just US, so they're not really exposed so much to US, and also they have more diversification in terms of their revenue stream as well. Yeah, so I hope that answers that question. So that's all I have for the US banks, I think. Yeah, let me hand it over to Iqban for the semicons. Thanks.
Thanks, Glenn. Yep, I'll be presenting on the US SSP's semicon segment. Our team is slower pace of growth. I'll explain more. As you can see, this is the worldwide semicon revenue growth. As you can see from 2003 to today, it's been through a series of booms and busts. And most recently, in the most recent data of January this year, we can see that the pace of growth has slowed down slightly. However, it is still worth commenting that the growth is still inching up at 18% year on year. Yep. Next slide, please. As for this chart itself, we broke down the different semiconductor companies into their categories. The first category is processor. So those are the companies that produce your AI processor chips, for example, NVIDIA and AMD. And for memory-wise, they are the companies that produce your high bandwidth memory chips and DRAM memory chips. For equipment-wise, they supply equipment to manufacture the semiconductor chips. They supply the equipment to TSMC Foundry. Yeah, so for processor-wise, we cover AMD and NVIDIA. They both netted quite impressive results for the latest December quarter of 24% and 78% respectively. For NVIDIA itself, they started ramping their Blackwell chips since last quarter. However, their guidance for next quarter, March, is 65%, which is below their year-on-year performance in the December quarter. So I think that's why analysts and other investors were quite uninspired by this kind of guidance for March quarter itself, because even though they have started ramping their Blackwell AI chips, they didn't guide very optimistic growth. Yeah, so for equipment-wise, they guided very optimistic growth. For example, for ASML, they guided 47% year-on-year returns for March quarter itself, as compared to their 29% performance which they performed in December quarter. This is because the strong guidance for equipment companies is because TSMC actually guided their capex to be $40 billion this year. So this $40 billion is a 34% increase year on year from last year. And 70% of their capex will go towards equipment manufacturers. So this means that TSMC will actually spend more money to buy the high-end AI equipment to manufacture the chips itself, because there is more demand for the gate-all-around packaging technology for the AI chips. Yeah, so that's why the equipment, we think that the equipment companies will stand to benefit a lot from this capex guidance from TSMC. Yeah, next slide. Yeah, so with regards to the processor chips revenue to the big tech capex, we can see that they are very closely correlated. For big tech itself, we included 4 companies: Google, Amazon, Meta, and Microsoft. So as you can see, as big tech spends more on their capex, a lot of this sum of money will actually go to AI processor chips. And even though there is a slight slowdown in AI processor chip revenue, we believe that the strong guidance of capex from the big techs will be able to support this kind of revenue growth going forward in the next quarter. Yeah, next slide, please. Next slide. Yeah. Okay. So talking about the tariff impacts on semiconductor companies, we know that there's been a lot of flip-flops here and there coming from Trump recently. Yeah. So I mean back to this chart itself. For just an overview for processor companies itself, they outsource a lot of their manufacturing to TSMC. And for memory chips itself, also they outsource most of it to Asia. A lot of them is to TSMC also. For equipment suppliers, they manufacture their equipments across Asia and also in the US. And most of their TSMC fabs are in Asia, mainly Taiwan. Yeah, so currently the latest news is that the current tariffs will exclude semiconductor chips and equipment. However, of course, I think there's a more recent news, like just like few minutes back, that Trump will implement the tariff. So as you can see, the rightmost column shows if there is a tariff implementation, how the companies will actually be affected by the tariff implementations. So we assess it based on how much revenue exposure they have to the US. For example, processor chip companies like Nvidia, they supply 47% of their revenue to the US. So they actually import a lot of their chips back to the US after they are being manufactured in Taiwan. So we think that there will be a high impact on if there were to be tariff on their chips. And for equipment wise, we think that the impact is medium because in comparison to the rest of the chip companies, they have lower revenue exposure to the US. Yeah, um so this is our breakdown. In the event that tariff were to happen for semiconductor, this is our evaluation of the impact. Yeah. Next slide, please. Yeah. As for Nvidia, I'll touch on it a bit. So we cover Nvidia. Currently, Nvidia's expectations for the next quarter will be 85% year-on-year growth. 85% is already very impressive. However, I think relative to the past few quarters' performance, 85% it seems to be slowing down. However, it's still very impressive because Nvidia has started ramping up the production of their Blackwell AI GPU chips, and we think that it has a growth runway to the third quarter of this year itself. Yeah, so um and as mentioned earlier, we do think that because of the positive guidance from big tech capex, we think that the big tech are still continuously purchasing Nvidia's Blackwell GPU chips. So we do think that will support their revenue growth for the next few quarters ahead. For Nvidia, we have a accumulate recommendation and target price 130 for now. Yeah. That's all for my end. I'll hand over the time back to Glenn. Thanks.
Yep. So I'll be covering for the rest of the slides since Helena's on leave. So yeah, just to caveat, it's really difficult to play this tariff game because whatever I say now, the next 5 minutes or even 10 minutes, it might not be relevant because he might just change his mind and and the whole outlook on the game would be different, right? On the whole market will be different. So we will be looking more at the long term, if we can, of course, the longer term outlook and try to find some fundamentals or segments that we believe that will be able to withstand this volatility and even despite what the tariffs that come in. But of course, certain sectors which are directly impacted by the tariffs, you can't avoid, right? So firstly, we'll go with cloud. We believe that the demand is still resilient. So cloud revenues have been increasing steadily. If you look at FY25, we do expect it to grow at a 3-year CAGR of 21.8%. And the next slide, it sort of explains, that the cloud companies, at least the big three, right? Look at Microsoft, Amazon, Google, their capex spending has not slowed down and is sustained. The growth has slowed down a little bit. You're looking around 50% as compared to, let's say, 60+% previously. So it's still very high, right? 50-odd%. But then again, this is based on the previous guidance that they did make. It would seem like years ago, right? But it's less than a quarter ago, 3 months ago or 2 months ago, right? And with whatever that's going on now with the whole macro environment, this could change, right? Their guidance could change on how much they'll be spending, but we believe that they will continue to spend, because firstly, they are not as affected, they're directly impacted, and also companies will need to continue to grow, to let's say move away from the let's say having a server to more cloud, and also in essence the whole cloud computing will have to continue to grow. So we believe that this is one of the more resilient sectors. Now moving on to the next slide. Yeah, the impact, like I said, is quite a minimal impact, right? There's no direct impact on the sector. However, we do see that there could be some increased hardware costs, and the growth is also unlikely to slow significantly. Of course, we could see a slight decline in demand because some companies might hold back, but the bigger ones will still have to continue to grow, and they will, their infrastructure is more stable in the sense where they will be able to withstand this current volatility, right? So while there will be some slowdown, but we believe that they will still continue to grow. So there's minimum impact from this trade war. Moving on to the next slide. Yeah, so jumping now to another like almost the entirely opposite is where we're looking at e-commerce, and this is a sector where it will be heavily impacted by tariffs, and the impact will be felt almost quite immediately, and we believe that there's a slower pace of growth for the e-commerce sector. Yeah, even before this whole announcement of tariffs and whatnot, the growth has already been quite stagnant. You look at the last huge increase was during the pandemic times, where we saw this huge resurgence in e-commerce, as everybody was stuck at home and spending. They were really spending all the government money that was given, right, in the US. However, what's happening now is that people are cutting back on spending, and hence we see this very slow low single digit kind of growth in 2023 and 2024. Now moving on to the next slide. Yep. It's not just the e-commerce growth that has been slowing down, it's also the traditional sales growth has also been slowing down. So in overall, it's just the consumer demand has not been as strong as it was, or at least the growth is not as strong, right? And I think what's the plan now for e-commerce would be to try to take away the market share, or try to take away more from traditional sales growth. But they're also seeing that sort of slow down slightly, especially since past the COVID era where they had this huge boom. Now moving on to the next slide, we'll be looking at, I think, the e-commerce impact from the trade war. You can see almost everything here is moderate at least, and some of it is high and severe. So the high and severe one would be the first party retailers. So you're looking at like Amazon, Walmart, where a lot of their home brand products are like Amazon basics, right? If you shop on Amazon, it comes directly from China. It's made in China, right? So this will be quite high because the cost will flow. If it doesn't flow to Amazon themselves, it will flow straight to the consumer, and that will increase the cost of the product. So the demand sales will definitely dip for that sector. So that is quite high. Severe wise will be those direct from China straight to the US consumer, and that will be companies like Temu and Shein, where they sell Chinese products in the American market. So I think that's one of the purpose of the tariffs, is to, at least in the for Trump, is to remove this kind of this Chinese companies selling products like direct to the US consumer. As for moderate wise, we're looking at party marketplaces like eBay, Etsy, even Amazon Marketplace, where they are more like middlemen. But of course, with overall slowdown in sales and demand, the fees that they earn and they earn through a number of transactions, right? This will also decline. For direct-to-consumer brands, these are all, some of it are quite US brands, right? But they all move their production to China because it's more, it makes more sense for them. It's also high to moderate, because their costs will increase possibly just overnight. And last but not least, the digital-only e-commerce like Shopify, it will be a moderate impact. There's no direct impact on them, but if the whole market and the whole sector that they are in faces a slowdown, then this will also impact them because their revenues really depend on how fast the growth is in that sector. Now moving on to the next slide. Yeah, we have one more for the streaming. So streaming, it's we just go first into Netflix. Netflix, you would think that they are growing quite steadily, but this is mainly due to really quite a bit of inorganic growth, in a sense where they are just increasing the cost, increasing their price, sorry, cost to consumers. So every time if they feel like their margins are dipping, or if they want to increase revenue, you will see it in your email, or if you have Netflix, it will just say, oh, your subscription has the price has changed from $16 to $19. So that's how they get that growth. It's not like their subscriber base is moving very quickly, but it's that they are just increasing the price. So that's how they are growing. Operating margin, so that's similar, right? They are just increasing the price. So moving forward for Netflix, it's really whether or not the demand can hold. And I think the main thing that they're trying to shift away from is to a more freemium model, right? Where they have a lower tier sort of subscription, but then they put in ads, right? So the pickup rate has been quite healthy, but the problem is that they are having some issues with their monetization. They're not able to do it as well as, say, YouTube, where they have this really, like, for decades, right, this inbuilt monetization, how they monetize, how they take from advertisers, right? So they are unable to do that. And now with the whole environment, we could see a dip in advertisers actually willing to pay money to advertise on Netflix. So we did have a reduced call with a target price of $870. Moving on to the next one. Yeah, we also have Spotify. Very similar story, in the sense that they are also in this streaming kind of thing, but more for music. Similarly, they are also trying to, the way they do that is by increasing the price, because the customer base is the growth, at least for the customer base, is being quite stagnant, right? So the only way that now they can improve their revenue is by increasing the price again. So you would have seen that if you subscribe to Spotify. I might personally have seen the price increase every other quarter or so. Yeah, so their free model is quite okay, right? But they are not able to, again, monetize it as well as let's say YouTube or YouTube Music, and they face the same issues as Netflix. Next slide will go into more into the, yeah, next slide please. Yeah, into the impact that they get from the trade war. So there's no direct impact because they don't have physical goods, right? But there is a lot of indirect impact, and the ripple effects will be felt through the weakened consumer demand, foreign exchange loss, and slower device upgrades. So basically, when people are feeling the pinch, and when the consumers are feeling the pinch, right, they will still have to buy food and groceries, right? But the first thing that they want to cut out would be this kind of streaming. They might go to free options, like they will look at maybe watch cable TV or go to YouTube where it's completely free, right? So they might lose some subscribers in a sense where the number of users might decline if, say, the tariffs are fully felt by the consumers and by the laymen. So we believe that it might be a moderate impact moving into the rest of the year. So next slide, I think that should be. Oh yeah, sorry, the last one. Yeah, this is I guess the one that has the most eyes on it now, which would be Apple. So even before these tariffs were announced, right, Apple was already facing a bit of a downturn in their revenue, growth in China, right? People were not buying iPhones as much as they would like, because of the Chinese phones that were entering the market. And not just that, but also globally, the demand, the revenue had declined a bit due to the demand. And now with the tariffs coming in, they did get this reprieve where Trump said, okay, we are not going to exempt electronics and iPhones, right? I think it's really meant for Apple, because Apple is one of the largest companies, the US companies, and their phones will get hit very, very hard by the tariffs, because most of it is made in China, right? So now there's a reprieve, but then again, he has come out to say that this is not permanent. So Apple would have to find a way to move around that. Maybe they will be moving production away from China, but I don't see them moving it back to the US, right? They were moving it to maybe another Asian country that has lower tariffs, right? But still cheaper than, of course, than China's the 100 or more than 100% tariff. So it's very volatile now for Apple. We are not sure where it will be going, because it depends very heavily on whatever Trump says or does. Yeah. So that's all, I think. Let me move on. I think the next slide will be sorry.
Thanks, Ben.
On to you, Zane. Thanks.
Yeah. So, good morning, everyone. I'll talk about some of the technicals for the S&P 500. So first up, this is the chart for S&P 500. Last week, we saw a rebound from this retest of this upward support line from the March 2020 bottom that's close to about 4,800, 4,900 points area. So for the week itself, the index was up 5.7%. I think we are likely to see a further rebound this week to retest the recent support breakdowns. So looking at the orange line as well as the blue line, which were the previous trendline support breakdowns. And this area at about 5,500 to about 5,700 is also coincides with the 50 to 61.8% Fibonacci retracement. When we take the swing high around 6,147, the swing low form at 4,835. Yeah, so I think that will be the next area of resistance at 5,500 to 5,700. Support likely will hold at 5,230 to 5,350, a bit of a higher low in the short term from last week. Yeah, so another notable thing was that S&P 500 is currently demonstrating a weak market breadth. So there's the blue line actually shows the percentage of stocks that are trading above their 200-day moving average, which is considered an important long-term moving average in an uptrend. So in an uptrend, stocks will definitely trade above this average. So when we see there's a lot of stocks, there's a high percentage of stocks trading below this 200 MA level, it shows there's a bit of capitulation happening in the market. Yeah, so this has happened about 5 to 6 times when you look at it in the past 10 years. So that's a notable event that happened last week as well during the market sell down. Yeah, then also last year when the bull market was strong, market breadth was about 60% of stocks was trading above this 200 MA level. So what does this mean? So when we look at in terms of the short-term S&P 500 returns following such instances, right, it actually bodes quite well in terms of the short-term returns from 1 week to 1 month after. So just last week, there was when at the lows is about 14.9% of S&P 500 stocks. Only 14.9% of S&P 500 stocks were above the 200 MA. In the last 5 times when this happened, on average, the 1 week returns was about 2.5%. And when we stretch out the time frame to 2 weeks to 1 month, 2 weeks returns was about on average 6.5%, and 1 month's returns was close to 10% at 9.7%. So that in the short term, that could actually be quite positive for a rebound after such a capitulation in terms of the market breadth based on historicals. Another thing was that we also had this slide last week. So another thing was that the VIX is coming off a large single day rate of change. So last week, I think on two Fridays ago, I think the single day rate of change actually hit slightly above 50. So that's quite notable in recent years as well. So in terms of, we also did this table, in terms of forward short-term S&P 500 returns following such instances of extreme fear in the market, right, it actually bodes quite well in terms of short-term returns as well. So on average, 1 week after such volatility, we are looking at on average say 2.6% returns. 2 weeks is about 3.5%, and 1 month is about 4.4%. So we also have our first data point since the 4th April, 50.9% single day spike in terms of the VIX. So the 1 week returns as of last Friday was 5.7%. So this actually looks like it could be continuing this historical trend of a short-term rebound of a short-term rebound following such volatility spikes. So that's all from me. I'll hand over time to Darren, who will cover on Paul's behalf for the Singapore Weekly. Thanks.
Yeah, thanks, Zane. Yeah, so I'll cover for Paul. He's at the Genting AGM. Yeah, so for the news this past week, nothing much in Singapore. And the US, they came out with the core CPI, which was down at the lowest point in 4 years. But basically, with the upcoming tariffs, this core CPI number is really insignificant and irrelevant because going forward, all eyes are on just the tariffs and the on and off of the tariffs. Yep. Next slide, please. Yeah, so for the theme for this week, so is this investing is like a rigged game. What we mean by that is basically because Trump, he can change the rules and outcomes with a daily tweet, like whatever he tweet on his Truth Social, then the markets will swing widely. And basically, like when you invest, the outcome is just determined on one guy only. So yeah, it's really not a good time. And basically buying on personality. So for us, we think in the current situation where the outcome is so depending on one guy, it's better not to play. Or if you want to if you are a long-term investor, you can invest with in shares that are trading at cheaper valuations and at a better yield. So you can get better odds from that. So for our tactical picks, we are on Singapore banks. So for Singapore banks, or rather for the Singapore market, it is down 11.6%, and it's even more than Vietnam 6.5%. So that is because it's surprising because Vietnam it was the greater hit by the tariffs, because of the reciprocal tariffs, and they're down 6.5%, and now Singapore is down 11.6%. Banks were down even more at 15%. But for us, banks remain strong. Yep. You can ask questions on. You can ask Glenn later for more about. Let me just explain a little bit. So right now, because of the recent sell down of 15%, the banks are now trading at a very attractive 7% yield. So there is a trifecta risk, but there are some positive offsets. Like in this current market, there are lower loans, but the local property demand, there is some demand for local property, as we've seen property sales quite strong. So there is some offset for the lower loans, and also there is some demand for liquidity likely, as in a more uncertain environment, corporates they are more, or rather they would like to be more liquid. So therefore they might take on more loans for liquidity purposes. So these are the two offsets for the lower loans. And also for rising bad debts, there's no credit cycle, and the loans growth rate was very slow over the past 3 years, 2.5%. So because the loans didn't really grow that much, so as a result, the risk of rising bad debt is also not very high. Yeah, and because of the lower interest rates, there's also lower NIMs. But with this, seen CASA rising, and with CASA rising, the banks can issue more loans at a longer dated bonds or longer dated instruments. So as a result, the yield will steepen. And yeah, there's also demand from capital markets, like for hedging purposes and wealth management purposes. So these are some of the offsets to lower NIMs as well. And for us right now, we avoid manufacturing because the low inventories and lean inventories because we expect a lower inventories throughout supply chains with the increased cost, because there's so much uncertainty there. So we believe manufacturers, they will they do not want to hold so much inventories because of so much uncertainty, so they'll have lower inventories, and that might trickle down to affect some of the supply chain operators and perhaps in the longer term some of the industrial REITs as well. Yeah, so for us, we think Singapore is a safe haven. So there are some proofs or some data points for that. So one of it is the widening bond yields with the US. So usually in a recession, the yields will rise, or rather, now the yields will rise, but usually in a recession, the US bond yields will fall because investors will pile their money into the yields, into US treasuries. But for now, we noted that the yields are instead rising, the US bond yields. So as a result, there is a widening of the bond yields with Singapore, and investors still continue to pile cash into Singapore. As a result, the Singapore yields still remain low, and in fact, is coming down as well. So this continues to widen. This is mainly because of strong fiscal capacity of Singapore, and on a relative basis, Singapore is also least impacted by reciprocal tariffs, like we are at 10%, while other countries are higher. And also because Singapore's Sing dollar strength, and as well as cheap valuations. Yeah, so for valuations, we have a separate chart later on the PE. Now the STI is traded at 11 times PE, so that is more than 1 time standard deviations below the mean. And right now, the US is facing some EM-like portfolio outflows as governments spend domestically. So we also have a chart over there in the later slides. Yeah, so in the week ahead, these are some of the events upcoming. We highlighted the ECB meeting because we're expecting another 25 basis points cut, perhaps another 3-4 cuts to come. And this ECB meeting, this further rate cuts for ECB will help to benefit Stoneweg REIT, which is one of our topics, as well as they'll benefit from any rate cuts, or rather they'll benefit immediately from any rate cuts. Yeah, and for corporate insights webinar, we have been fast in 2 days time, and we have LHN next week. Yeah. So for Singapore Banks Index, so we see this chart. This chart shows that because of the share price performance over the past week, the dividend yield is now at 7%. So this is almost according to this chart, it's like more than 5-year high, and the price to book has fallen to about 1.4 times. Yeah, so this looks really attractive. And for the dividend yield spread, likewise, because of the fact that the 10-year Singapore government savings or 10-year Singapore government security bond yield is low, or rather it fell also, and the share price for REITs, it also fell. Therefore, the forward dividend yield increased, and as a result, this 10-year dividend yield spread is now trading above the historical average, which is looking more attractive. So REITs are starting to look more attractive, but we believe in the near term, for REITs, you'll still be very volatile, and any possible movement will likely come as the Fed starts to towards a more dovish stance, and as a result, more rate cuts are likely. So that we think that will then really boost the REIT share price performance. So perhaps in the second half or next year. Yeah. Next slide, please. Yeah. So now, like we mentioned, Singapore is looking more as a safe haven. Like we see here, like the 10-year bond yield differentials with Switzerland and the US Treasury bond. So it rose, and likewise with Singapore as well, it continues to increase. So like usually in a recession, investors will put their money into treasuries, and as a result, the bond yields will fall for US. But currently, there's a sell down as a result. The US Treasuries, the bond yield rose, while Singapore remains flat or even decrease. So as a result, you see this 10-year bond differential continues to increase between Singapore and the US, as well as US and Switzerland. Yeah, so this just shows that Singapore is turning into a global safe haven where investors continue to pile their money into Singapore as compared to the US. Yeah, and the chart on the right, it shows the forward PE of Singapore. Due to the recent performance of the STI, we see that the index, the PE is now trading at a slightly above 11, like 11.4 times. So that is minus 1 time standard deviations away from the average of 14 times. So that is cheap, considered is at the bottom quartile versus the average of 14 times. Yeah. Next slide, please. Yeah. So this chart, it shows that the amount of treasuries that are held by foreigners. So if you take a look at the yellow line, so that is the total about 8 trillion of treasuries that are held by foreigners. So going forward, it's likely that these foreign sovereigns like China and such, they'll start to reduce treasuries and they'll want to repatriate money back to their country. And as they do some of their own fiscal spending because of the absence of trade from this trade war, so they'll likely to boost the economy, they'll need to spend more. So they'll likely reduce their treasuries and repatriate more of their money back to their own country. So we think going forward, these foreign holders will likely come down. And from the right side chart, we see the US corporate stocks, the foreign holders. You see over the past couple of years, it really spiked up. So there is a huge surge in foreign inflows into the US stock market, as US corporate stocks. So as a result, there is a risk that that it is possible that there will be portfolio outflows from the US in similar situation to some of the emerging markets. Yep, I think that's all for me. Yeah. Thanks. We'll move on to Q&A. Thanks. Yeah, just a quick note. Paul will be joining in a bit. Yeah, so you can ask your questions.
Thanks, Darren. I'll take on some questions. I think there's some request to flash the slide on tariff impact. Yeah. Zane, could you go to that slide? Thanks. Yeah, I mean just a note. The recording for this will be put up on YouTube also. So if you miss any parts of our presentation, you may refer to the YouTube's recording as well. Yeah, so I think there's a question. Even the UMS clients are applied material and lump research, though the impact upon tariff are medium and low, respectively. But with TSMC's impact being high, this challenge will still trickle down to UMS in the form of second order effects, right? How much will the impact be versus FY24 results? Yep, definitely. I think the whole semiconductor ecosystem is very integrated lah. So I think when I state here high, medium, or low impact, right? This is only the direct impact upon the companies itself. Because the whole ecosystem is so integrated, the impacts of tariff will definitely trickle down to UMS as well. Yeah. So how much will the impact be versus FY24 results? I think it's a bit hard to answer that question because it also depends on the company's cash management. How much they still like for example if their costs are directly impacted by the tariff itself, do they still want to spend on capex in order to build up their current inventory? So it really depends on how much the company is still guiding capex forward. Yeah. So I think the best early indicator for UMS results is TSMC's capex guidance because I think in my opinion, right now ASML and Lam Research are guiding a very strong results performance because of TSMC's capex guidance. So because and it will trickle down to UMS because if for example Applied Material and Lam Research perform well, then they will be more willing to spend on their capex and it will benefit UMS. So I think the earliest indicator will be TSMC's capex guidance. Hopefully that gives some clarity to it. But even however, I can't really quantify how much impact there will be. Another question is, what is Meta CapEx like compared to Microsoft, Amazon, Google CapEx spending that was mentioned? Yeah. So each of the four companies provided CapEx guidance for the next quarter. Uh, from what I can see, based on the last 12 months CapEx, out of the four companies itself, Google actually guided a slightly slower growth in CapEx compared to the other three. Google guided a 56% last 12 months growth compared to 63% in the previous quarter. Yeah, whereas for Meta, Microsoft, and Amazon, they all guided a higher CapEx spend. So out of these three companies, Meta, Microsoft, and Amazon, Meta actually guided the most aggressive spend out of the three companies. They guided a 71% last 12 months year-on-year growth. Yeah, compared to 37%, which was recorded in the fourth quarter. Yeah, so hope that answers your question. Meta's CapEx is the most aggressive compared to the other three companies. I think there's a comment on the chat itself. Will the US tariff be negative across the semiconductor industry, or will only specific subsectors be more impacted? Yeah, so I hope this slide actually answers your question because if you break it down, the semiconductor subsectors, it will be processor, memory, equipment, and foundry. Yeah, so the direct impacts are listed on this slide itself. You may refer to them. Yeah, I think that's all from my end. I'll hand over to my other colleagues. Thanks.
Hey, thanks, Iqbal. Yeah. So quite a number of questions for me. Okay, I'll take the easy one first, which is the first one actually. It asks, is regarding Grab. So it's asking, you listed digital banking as an investment merit for Grab. Any successful examples of successful profitable banks in the world, and how Grab is similar to them? Yeah, I think when you say banks, you mean digital banks, right? Yeah, because they are a digital bank. They're not the traditional bank that we see, like JP Morgan or DBS, those kind of banks. Yeah, so if you look at the successful digital banks around the world, you can see WeBank in China, Ally Bank in US, Nubank in Brazil. Yeah, so how it is similar is that they do have an existing user base, so they started out strong, right? They have their whole ecosystem and portfolio of Grab users, right? And these are the users that they actually want to have as a banking user as well, because these are the underbanked population, right? And they also have a lot of data. That's a very good thing because this provides them the ability to come out with personalized financial products. In a sense that, let's say if you like to buy a lot of food, then they will say, oh, okay, there's this, maybe there's this promotion, micro loan, or maybe you like to take ride hailing, right? I think there's this news that came out recently that they are even there's some talks about providing buy now pay later for Grab food or like food deliveries, which is quite interesting. A $6 meal, you can do a $2 installments over three weeks or something. Yeah, so that's the way that they're trying to push out all these new interesting products. Yeah, also the cost efficiency and speed, because they are digital first, so they are able to scale faster than the traditional bank would be able to. And last but not least, I think I said it earlier, is the holistic ecosystem integration, because they will be able to very easily put in their digital bank into the system that they already have in place, which encompasses your transport, encompasses your food delivery, any form of delivery actually. Yeah, so this banking arm can really provide an integrated solution. I think one example would be where they can give you like discounts if you take up a loan, right? So maybe they offer you like maybe 5 discounts, like 5 discount codes if you take up this loan, or you get cashback if you use their credit card, right? Which they are already doing. If you look at not just Grab, right? If you look at Shopee, C Limited, they do provide a higher cashback if you use their Merrybank credit card, right? If you make purchases on Shopee. So I think their main thing would be the good thing for Grab is that they are in a different market, right? They are looking at the delivery drivers, riders, as well as the people who use the service. Whereas, if you look at their main competitor, at least in Southeast Asia, would be Shopee, and but they are targeting the people that use the shopping platform. Of course, there will be some overlap, right? Because people who buy on Shopee will most likely use Grab. So there will be some overlap. So I think it's whether or not which company will be better able to maybe give a better rate, or how they do their whole overall platform in order to attract their customer. Yeah, I hope that answers it. It should be detailed enough. Okay, someone asked how the MES policy easing affect the 3 local banks. Yeah, okay, there's quite a lot of likes for this question. Yeah, I guess in a sense, there is is more of a short-term improvement for the banks, but then again, it's not it's not very significant. It will help them a bit, in terms of the currency and exchange rate exposure. So they will be able, this will create a more stable exchange rate environment, and they will be able to manage their foreign exchange exposures more effectively. So this will help them in their trade finance as well as cross-border transactions. Also improve their funding and net interest margins. They'll be able to keep their funding costs more stable. And last but not least, also their credit demand and quality. This will help to improve a bit of their demand, right? But then again, if the whole economy is in a slowdown, then it will do not a lot, yeah, to help the loans growth. So but one thing, like what Darren mentioned earlier, is that Singapore is really seen now as like a safe haven, sort of like in ASEAN. So we could see the loans demand actually not I wouldn't be so positive as to say improve, but if it can hold stable, right, at this, we're looking at around mid-single digit sort of year-on-year growth. Every month we get this MES data, right? So if it could hold stable, at this around 4 to 5%, that would be a very positive sign that, instead of a decline, we are seeing some loans actually some demand shift here into Singapore. Yeah, but I mean, overall, it's really quite short term sort of benefit, but the way the banks will be able to move forward is really how they run their business, right? How they look at the core fundamentals of the bank. Like Darren also mentioned, again, there are many ways that the banks are able to ride out these uncertain times and volatility. I think there's a big worry on, of course, the credit costs. Will credit costs increase, right? As we could see higher allowances, higher NPLs, higher defaults. Yeah, but again, the growth for loans has been very slow over the last 3 years, right? Even the recovery post-COVID was not spectacular. You're looking at mid-single digit, or even low single digit kind of growth. So there isn't really any like huge uptick in loans growth where it can come crashing down, right? Because it's already so low. And one more thing, if you look at the provisions wise, the good thing about Singapore banks is that I think, once bitten, twice shy, right? They were hit by COVID, and now they are keeping a lot of what you would call management overlay. So this is a huge sum of money that they are keeping aside in case of bad times, right? They kept saying it, and after COVID, after the whole COVID era where everything recovered, a lot of analysts were asking, why don't you release all this management overlay, right? And that will give this huge boost to their earnings. But the plan that they had was that we don't need to, firstly because they were growing, right? Their fee income was growing, margins were growing, so they didn't need to inorganically boost their earnings, right? And they were saying that, okay, we will just keep this first in case something happens, right? Because they were saying that, with COVID, they weren't as prepared, but now they are trying to be very prudent. And all 3 banks in Singapore are doing this, right? DBS is really the only one that openly says how much they have. They have around 2 billion of management overlay. So, they can now I'm very sure during the next earnings call we will hear the senior management say, you see, there's the reason why we hold management overlay, right? It's so that in times like this, when there might be an uptick in provisions, in specific provisions, they will be able to release that general provisions so you can offset, right? And then allowances will be flat or at least within their guidance. So that's the thing that we believe that will provide stability, at least in the near to medium term for the banks. I mean, apart from the rest of their segments, because I think the main highlight for Singapore banks, at least in banks in general, would be that uptick in provisions and credit costs. Yeah, so I hope, I think I went past the answer already, but I hope that gives some clarity and into why we see the Singapore banks as this stable base, I mean, besides the point that the dividend yield is also very high. Yeah. Okay, there's quite a lot of other questions, so let me just look through again. Okay, there's one here on Alibaba, Amazon. So it's asking on the impact on e-commerce and can their cloud business make up for the lack of growth here? Yeah, I will speak on Amazon because we don't cover Alibaba, but I mean it should be. I think I'm not sure whether it's very similar, but I think it should be quite similar. So Amazon, if you look at their e-commerce business, right, the margins are very, very thin, right? It has been slow, margins have still been very thin. They have not been able to improve it. Of course, if you look at their revenue or top line figure, you can see that their e-commerce segment is such a huge sum, such a huge amount, right? It makes up the more majority of their revenue. But if you drill down to operating income and net income, you actually notice that their cloud sector makes up for around, I think, 50 odd percent, right? Not sure if that's the exact figure, but it's around half of the operating and net income. So that's where we see that their growth will be coming in the future, right? Of course, e-commerce now it's so stagnant, and then now it's hit further by the tariffs. So that will probably slow down. And I believe that yes, their cloud business should be able to make up for the lack of growth in the e-commerce sector, at least for Amazon. Yeah. Because that's where, if you look at the bottom line, that's where the growth is really coming from, their cloud business, not from their e-commerce sector, which has been sort of very sluggish for at least the past few years. Would there be a sustained weakening of the USD, and what's the impact on the US stocks? Yeah, if you look at it, from the point of a Singaporean, if you're investing, of course, if you are going to hold the US dollar, if you're not going to, move it back to Sing dollar, then there will be an impact, right? The sustained weakening, like what I think Darren mentioned earlier, it is really based on one man, he just says something and the market moves. So I can't tell you to be certain, will there be a sustained weakening of the USD? If tomorrow he says that he scraps everything, then maybe everything will go back to what it was 1 week ago, right? Or it seems like a lifetime ago. So yeah, so this is a question that I think is on the minds of almost everybody now, and nobody knows what will happen. Yeah, I think maybe even Trump himself doesn't know. Yeah, so okay, are there any other growth areas that Apple could move into to continue to be a mega cap? Yeah, very good question. I really doubt it that there will be any other growth areas. Sorry, where did the question go? Apple, yeah, if you look at the growth areas, there isn't many, right? They have built up an ecosystem, but the ecosystem is really based a lot on the products that they sell, right? They are building, they have been selling this lifestyle. They don't really sell tech per se. They're selling a lifestyle, they're selling the ecosystem. So they have based their whole, and they have got successful doing it, right? Profitable, very profitable, grown to be such a big company. But now that, these tariffs are hitting them, what they are thinking is that they are not onshoring, their production to US, because the cost will be too high. So they're actually moving it away from China, right? Possibly India, where it's cheaper to do that because of the tariffs, right? So that's not what the Trump administration or Trump himself wants. He wants it to be moved into the US. but Apple doesn't think that that will make economic sense or it will make profits for them because the cost is too high. Yeah, so for Apple, it is really very dependent on what the Trump administration wants to do, and if they want to hit them some more, or they remove that exemption, and then their cost will go up and everything will go up for Apple. So it's a very volatile time for Apple. How well they will do in the future will really depend very much on what he says. Yeah. And it's also interesting that they have not really made any statement yet, on the whole whatever that's happening. So the next results earnings will be very interesting to see how they want to adjust, and where they will be going ahead in the future. Then I think we can get more clarity on how they continue to be this, as you said it, mega cap. Okay, I think I'll leave some of these questions for Paul. Okay, yeah, there's a question on the long and short-term treasury yield, which has been quite confusing. Yeah, can you enlighten? Yes, yeah, it's been quite confusing. Also, someone asked, what's the possible reasons for the US 10-year yield? So, yeah, maybe I'll just, the more direct question, I think will explain, a bit on the long and short term as well. So, the possible reasons for the rising. So in times like this, we usually see when the market is down that the 10-year yield will decline, right? But what we're seeing is the opposite, which is sparking quite a bit of fear, where that investors and are actually dumping the 10-year US 10-year, right? Which is why the yield is rising. So they are seeing that US is not really a safe haven to put in. Yeah, they are really not looking at it as a safe haven anymore. So they are moving out of this of the US to maybe go hopefully into Singapore. So that's where we could see some pick back up. So one of the possible reasons, yeah, is that they're not seeing it really as a safe haven anymore, because it's too volatile, right? The whole market, the whole US market is dependent on one man, right? And what he says and does. So that doesn't speak for stability much, right? So which is possibly one of the reasons why it's not really seen as a safe haven, because nobody can predict what he's saying. And if you don't have predictability in anything you do, then people will just move somewhere where it's in other words, where they see it safer, because there is more predictability. Yeah, so predictability is a big factor when you look at whether is it a safe haven or not. Yeah, there's one on okay, try to understand if iPhone, Apple, semicons manufactured in China are shipped used in China and outside China. Not very sure what the question is trying to say. Will this escape tariffs? Yeah, no idea what. Oh, okay, I think I get what you're trying to say. Okay, I think I know the question. So you're basically saying if it's manufactured in China and then it's shipped to other countries, will this escape tariff? Yeah. The tariffs are only from US to China. But you'd understand why is this such a big deal? It's because US is such a big market. It's the main market for many companies, right? Like for iPhone, for example, it is the main market for where they have the highest spending power, right? And that's the reason why everybody wants to sell to the US. It's because of that, right? So the plan is, of course, for these companies to expand the non-US demand outside, but the spending power of all the other countries cannot compete to the largest single market, which is the US, which is why there is such a significant impact on the tariffs. Yeah, so to answer your question, yeah, if they sell to outside China, of course, outside US, sorry, yeah, then it will escape tariffs. But there are some caveats of that, being that if it's a US company and if there are retaliatory tariffs on US, then if let's say if an iPhone is being sold to that country that put up the tariffs, like let's say for example China, right? Then of course it will still be tariffed. Yeah. But now that everything has been, a 90-day pause, right? So time will tell what we are looking at. Okay, that's construction. I'll leave that for Iban. Okay, I hope that is all for me. Great. Yeah. Okay, maybe I'll hand it to the rest of my colleagues. Yeah, thanks.
Thanks, Glenn. Yeah, hi there. Do you think shareholders should subscribe to FCT preferential offering at $2.05? Yeah, I think you should, because if you don't, you'll definitely be diluted. Yeah, but let me just talk a little bit about the reason why they're even raising this and our stance on the deal. Yeah, so they're actually acquiring the North Point City South Wing. Based on what they mentioned, the deal is slightly accretive, 1.5% accretive, but the way it's structured is such that they're using the EFR proceeds to pay off a lot of the higher interest rate loans. So as a result, they are getting the accretion more from there rather than the fact that the acquisition itself is a good deal, because the North Point City South Wing was done at a NPI yield of 4.5%, so that is lower than what it was for Next. The Next last year they acquired at 4.8%, so that is a better deal than this. So if we are more neutral on the deal itself, mainly because of the fact that they are raising the capital to pay off the higher yielding debt, as well as the potential issuance of the PERP as well to pay off the higher yielding debt as well. So if you strip that out, the deal might not be that accretive. So we are more neutral, but in the longer term, there are some synergies with the North Point City North Wing as well. So the potential or upside is from cost savings and improving the NPI margin for North Point City South Wing, which is currently slightly under the rest of the portfolio. So there is some potential in the longer term for growth there. So for this specific preferential offering at $2.05, yeah, we think you should subscribe to it. Otherwise, there will be a little bit of dilution on your end. Yeah, so that is our take. Okay, the next question is, do you think shareholders should accept the Paragon privatization offer? Yeah, so my point of view is because Paragon REIT is not very liquid, and like the trading volume is not a lot. So that's one of the reasons also I think investors should accept the Paragon REIT offer, because first of all, it's at 1.07 times. So the offer is considered fair, and it's also much, if I'm not wrong, like 10 over percent from the previous last close before the offer. Let me just take a look. So before the offer was made, Paragon was traded about 89 cents at that level. So the offer was at 98 cents, and that doesn't include the dividends. So there is still another 2+ cents dividends. So we think it is a good opportunity for investors in Paragon REIT to monetize this to realize their gains from this investment, because first of all, immediately you get 98 cents, and there are some issues as well. For instance, for Paragon REIT, according to the manager, they do need to undergo some AEIs. So there's a follow-up question as well, 300 to 600 million AEI. So as a result, because Paragon REIT is like their main portfolio, Paragon is the main asset in the portfolio. So when this AEI will happen, and if it's still a listed entity, there will be some volatility to the earnings and NPI and DPU as well. So it makes more sense for them to privatize before they do any AEIs. So that is one. And also Paragon is a older building, or rather Paragon is older compared to some of the nearby malls as well. So that's also another reason why they need to undergo this AEI. Yeah, but all in all, we think it is a good offer because the offer was at 98 cents, and all in all, you're getting about slightly over $1 as compared to the previous last trading share price before the offer of about 80 over cents. So immediately there's some good upside for investors. And in my view, if this scheme doesn't go through, like if this offer falls through, then the share price of Paragon REIT will definitely fall as well. That's what our view. Because now it's at 96 cents. Yeah, if it doesn't go through, the share price will likely be sold down. Yeah, so yeah, that's our take. Should the offer value for Paragon REIT take into consideration the post AI value? Yeah, so right now the AI amount that the sponsor indicated is 300 to 600 million. Yeah, so it's still quite uncertain how much exactly will be invested into the AI. So yeah, it's quite hard to take in consideration what the post AI value would be as well. The proposed AI with consideration of stage execution reflects the functionality of the major. Yeah, it does, but at the same time, in my view, I think that the offer price is relatively fair at 1.07 times price to NAV and at 98 cents. So yeah, I think ultimately investors should just monetize this and look for other opportunities using the funds once the proceeds, you receive the proceeds from the privatization. Uh, there's another question, Darren. Any idea why AIM's APEC is lagging when there are many tailwinds assisting this REIT, as in RBA cutting rates soon, Australia 10% tariff, Singapore's 10%, and high rental reversion percentage in their properties? Yeah, so you're right in that. But going forward for logistics, we think that because of the incoming prime logistics supply space, we think rental reversions will likely start slowing quite significantly from the double digits, high teens, 20s to the mid-ish to high single digit rental reversions. And for specifically the industrial sector, like there was one section that Paul's slides earlier as well that said manufacturers they are like manufacturers they are likely to start holding less inventory, so that might affect industrial demand as well and logistics demand in the near term, near to mid term as well. So that we might see some headwinds from these tariffs going forward in over the next couple of years, depending what happens. So there are some potential headwinds there. But relatively wise, looking at the share price, it is I wouldn't say it's really lagging the other industrial REITs. The like MLT, for instance, it's down even more significantly than AIM's APEC REIT. So I wouldn't really say it's underperforming its peers. It's more of similar performance in line based on just look at the share price. AIM's one of the REITs that has growing DPU payouts after it reflects up yet. Yeah, that's true. Yeah, recently they've also managed to issue a new PERP. So that PERP there is used to refinance the outstanding PERP that is due in a couple of months' time. So yeah, when they refinance that, they will result in some significant, if I'm not wrong, almost 1% in interest savings. Yeah, so that is another plus for AIMS very so yeah, but just in the current market conditions with all the tariffs, is very uncertain for logistic REITs, especially on what will happen like with increasing input costs and such. Yeah. Yeah, that's all for me. What's the deadline for setting Paragon? Let me check. I'll get back to you. I'll type in the chat box. Yeah, I think there are some other questions. I'll hand it to my colleagues. Thanks.
Thanks, Darren. I'll take on some more questions. What's your view on micromechanic and the tariff impact on it? Yeah, we don't cover micromechanic, but from my brief look through, they have some revenue segments to China, and they supply parts to equipment makers in China and also foundry in China. So I suspect it will be like SMIC, manufacturing for semiconductor in China. And they also have a segment around 10+% to the US. So I think that will be your general equipment makers like Lam Research and Applied Material. Yeah, so I think as mentioned just now, if the tariff were to be implemented on semiconductor, there will be a ripple effect across the entire semiconductor supply chain. So micromechanic will also definitely get hit. Yeah, so for example, SMIC as a foundry in China, if they were to supply to companies like Qualcomm in the US, then if tariff were to be directly implemented, then SMIC's revenue will get hit. Maybe they'll get a lower capex, they will spend less, and then micromechanic will get hit as a result. Yeah, so this is the kind of linkage within the semiconductor industry. Yeah. Next question, should a recession hit the US later, how will this impact the construction industry and plants in Singapore? Is the dropping steel price damaging PRC Asia in spite of a big order book? Yeah, I think that's a good question. So I went to take a look at the past historical data on recession as well as um, Singapore's government contracts in terms of contracts awarded, right? From the previous major recession of 2007 to 2009, I realized that Singapore government's construction contracts awarded actually spiked up. So I think an explanation to that is in order to mitigate the effects of recession, the Singapore government will actually spend more in terms of fiscal spending in the domestic construction industry so as to support the GDP growth itself. So to answer your question, if a recession were to hit the US later, I think construction is still quite sheltered from a recession in the US, and construction industry itself in Singapore may actually benefit because maybe the government may actually aggressively promote public projects and award more tenders as a result. Yeah, but of course that is not confirmed or anything. It's just like a kind of story that I'm throwing out right now. Yeah, but based on historical data, yes, if there's a recession, the government will actually use contracts to support Singapore's GDP growth. Yeah. The second part is the dropping steel price damaging PRC Asia in spite of a big order book? Yeah, so for steel price itself, what affects the steel price most directly is China's construction. Right now, PRC Asia's revenue consists of two components. One is steel price, the other one is volume itself. So even though steel prices has been dropping for the past one or 2 years, we do think that for FY25 itself, PRC Asia's volume of steel will actually offset this drop in price because Terminal 5 will begin construction in the first half of this year. So PRC with 70% market share in steel will actually benefit from the from the construction projects when they start to progress throughout this year itself. So we do think that the benefits that PRC Asia will get in terms of the higher volume in steel will offset the kind of drop in steel prices. Yeah, so hope that answers your question. Next question, is ASML and TSM relatively unscathed in this tariff storm? Any other mega cap would you say has come out unscathed? No, definitely not. ASML and TSMC is not unscathed because they will definitely be impacted uh, uh, if the global supply chains are impacted by the tariff itself. And of course, right now there is no direct impact on semiconductor. However, if Trump come out and flip the switch, then they will definitely be impacted quite a lot because, for example, TSMC, they already have 70% of revenue to the US itself. So if Trump come out and say and decide to tariff the semiconductor chips, then TSMC will be directly impacted. Yeah. Next question is, does PRC Asia carry out steel bar prices hedging? Will it get trapped by the forward higher prices it hedged during the earlier period? Should there be a downturn in the construction sector? Yeah, so for PRC Asia, there's a smaller revenue segment called trading. So I believe they do carry out hedging over there. So trading itself represents around 10% of their revenue. It's very small. The majority, 90+% of their revenue still comes from the steel contracts itself. Yeah. So if the steel prices were to turn into an upturn, I don't think PRC Asia will be impacted that much. Yeah. When we heard AGM for special dividend, special dividend is confirmed already. So there's 2 dates that you have to take note of. These 2 dates are both in May. So one is I can't remember the specific details. It's either 7 or 9 of May. So that one is the last date that you have to be that you can actually own their shares and get the dividends. Then the dividends payout itself will be 20 plus May. Sorry, I can't really remember it offhand, but these 2 dates are in May itself. So yeah, we do have to keep a lookout. If you are unsure of where to check, I think you can ask in the podium speech here again, then I can get back to you from there. Yeah. Or you can send or you can email me also. Yeah. Yeah, I think that's all from my end for now. I'll hand over to my other colleagues. Thanks.
Hey, thanks, Iban. Yeah. Okay, let me try some of the questions because Paul is still stuck in his meeting. Yeah, maybe the first one here is the USD weakening good or bad for Singapore market? Which sectors are more affected by USD weakening? It's both, it's mixed, it's good and bad, right? Good side, it means that the goods that we import from US is relatively cheaper, and this might lower the input cost as well as ease some inflationary pressures for companies and consumers who rely on these US imports. But then again, it can also be detrimental towards our very export-driven economy because a lot of these many of the companies, they do price their goods in the US. So when the USD weakens, we could see these exports, become more expensive in terms of foreign currency, and this will really squeeze some of their profits. It could also, this is we put aside the tariffs, right? Because there's a whole different basket of eggs. Yeah, so the headwind could also slow the export volumes and hurt some of the sector growth that relies on this global demand. And you top that on top of the tariffs, then it's double effect, right? The financial sector could also be hit a little bit because some of the financial services like wealth management and forex trading, they are very sensitive to exchange rate fluctuations. So it could reduce a strengthening Sing dollar could reduce the profitability of the cross-border transactions, as well as some hedging operations. And a lot of the sectors like the logistics and shipping, they could see their margins compress also as their pricing advantage does diminish. Yeah, so I think I already did answer the question on which sectors will most likely be affected. It will be the export-oriented, import-oriented, financial services, logistics, and shipping. So basically, almost all the sectors, if you look in the Singapore market. Yeah, so that might also be the reasons why MAS came out this morning to sort of to ease some of these worries that if the USD weakens too fast or too quickly, right, against the Sing dollar, right, you will see a lot of these impacts, right, accelerate much faster. So now it's sort of a slowdown in some of these impacts that we are seeing. It doesn't remove them completely. It's not a permanent fix, but at least it's a bit of a reprieve in this kind of turbulent times. Let me try some of them. Okay. Somebody asked, can you share your take when China starts dumping US treasuries? What will be the impact on stock and bond market for Singapore, US, China, Hong Kong, which sectors? Okay, so the US, we believe that the US treasury yield might surge, but again, China doesn't want to also make it too disorderly or too obvious, suddenly just basically just sell everything. Right, and this is mainly because the US can also always freeze the holdings that China has. So I don't think there is this is not very probable in that case. Okay, there's one on what's the impact of tariff game on Thai Bear, CO, and PropMax, if any. There's no direct impact on these companies like what you mentioned, but of course there will be, like what we keep repeating, is that there will be a lot of indirect impact, mainly through slower economy as well as the loss of confidence. So a lot of these companies, you see that they might not have a direct impact, but the indirect impact, it will affect almost the whole economy, and not just these companies. Also, a lot of them will get affected in some way or the other, where you'll see the slower economy will reduce the demand, consumer demand, spending power, etc. So we don't cover Alibaba, so I can't answer that. I think there's one I saw. Sorry. Let me. Okay. Will the US tariffs drive the US and global economy into recession? How will it impact Singapore economy? If you look at a lot of the bulge brackets, right, have come out to showcase what is their forecast, right? The probability. I think the most notable one was JP Morgan. They increased their chances of recession to 60%, right? So if he continues on this war path, right, trade war path, right, and really implements all the tariffs after the 90-day pause, we really could see the global economy going into a recession. And how would it impact Singapore economy? It'll be very similar to the past recessions, but Singapore economy is very, in this sense, right, it's more stable because we will be concentrating on the ASEAN, right? There are a lot of talks that are going on now amongst the Asian countries, right? The Asian ASEAN countries, to try to shift away from the US. So it will have the same impact, right, as it is with any other country and economy, where we would see a decline. Unemployment might increase. So that is the main thing. But then again, right, it is really hard to predict whether or not there will be whether this will come true or not, because if he decides to make some agreements with all these companies, then all these countries, sorry, then we will maybe see a recovery. Yeah, but like we have been saying again and again, it's dependent on whatever decision he makes. Okay. Yeah, maybe I'll hand it over to Zane first for the TA. Yeah, thanks.
Thanks, Glenn. I'll do a bit of the TA first, so let me just share my screen. So the first question is on sets. Yeah, I think for sets overall, still you still see very weak kind of price action, a bit of a rebound since middle of last week, but I think still likely to see a bit or still likely to find resistance above like 275, where there's 275, 276, where there's the 10 MA level, as well as a recent swing high. And above 280, there's also likely to be resistance as well. So I think for now, perhaps it could just trade a bit sideways with some support at a recent lows close to 245, 250, likely to hold as a temporary support. So I think probably just a bit of sideways. Yeah, but the downtrend is still uh quite strong. Yeah, then for Zixing, I think overall quite range bound. So ever since it broke below this 0.027, 0.028 level, this has become a resistance. And support has shifted to about 0.024, 0.025 this area. So I think we will just be quite similar to what we see in the past where you just uh trade sideways for a very long period of time. Just now that the range has shifted lower, I think to about 0.024 to about 0.028, this area over here. That's why I'm expecting some range consolidation. And then for Bank of China, yeah, for Bank of China, I think for now there's some a bit of rebound since support around 410, but likely to face resistance from about 445 to about 455 area, where this was the gap down that happened last Monday. And then this was a consolidation support area before that. So I think for now, probably a bit of resistance from there. There's also a 20-day MA level. I think for now, support will probably be around like 427, which was our previous horizontal support, and currently the 5-day MA as well. So I think price might just trade between this around 427 to about 455, this area, doing a bit of a sideways in the meantime. Yeah. Then see what's the other questions. Okay, then there's some question on Singtel, Oitech, as well as Propnex. Yeah, so for Singtel, I think it's been quite sideways. Generally still one of the more resilient counters during this market sell down. Yeah, last week was holding around still above around 330s, 330 to 340 this area. Then doing a bit of rebound, 350, sorry, 365 or there's some resistance. So I think for now probably still quite sideways. I think support for now, assuming that if the market does stabilize a bit, I think 348, thinks this area will be a support. So I think we're just still moving a bit sideways for now. Yeah. Okay, then for oil tech, yeah, for oil tech, I think uh likely to face some resistance. So I think there was a breakdown of like 108, 109 level last Monday or high volume. Then currently it looks like it's doing a retest over here as well. Which currently the 20 AM, which has faced a bit of resistance. So I think this level of breakdown over here around above 110 should be the short-term resistance. Yeah. Yeah, on the weekly itself, it's also reconnecting the 5 MA as well as the 20 MA. So there could be some resistance over here. Then short-term support for now probably around 99 cents to about uh, $1.02 this area over here. Yeah, so we might just do a bit of pullback and do a bit of sideways consolidation. Yeah, but I think overall the trend has started to turn down a little bit since the breakdown from this blue trend line support, as well as we are starting to see lower highs and lower lows being formed. Yeah. And then for prompt next, I think for now, yeah, a bit of rebound from the $1 psychological support level. Then doing a bit of rebound, but I expect resistance to hold above 110. So 110 previously there was this sideways consolidation range over here, um, which had a strong support, but now we're likely to hold as quite a strong resistance. So I think for now, 110 will be a resistance, then support probably around 105 about there, for the time being. Yeah. So I think in general for the individual counters, all quite kind of similar. After the sell down, we're seeing a bit of rebound, but I think with the with the breakdowns in terms of the short-term supports, that will be hold up as the resistance for now. So we might see some pullbacks from there and see whether it can form the higher low. Not see whether it can form the recent this swing low. It's a bit of short-term support for now. Then other questions on Yangtze Financial as well as shipbuilding and Rex International. So for Yangtze Financial, I think we're seeing this uptrend turn down for now. So the previously was a steady uptrend, there was a break of this trend line support as well as some of the moving averages like the 10-day, the 10 MA as well as 20 MA. So currently, I think we should do a bit of retest, but find resistance around 72 cents, where there's a 10 as well as 20-day MA level and also this trend line breakdown. Yeah, so this 72 cents was also a swing low level from this before it made a lower high bound. So I think 72 cents will be quite a significant resistance for now. Support I think will still likely hold at the recent support around 66 cents level. Yeah, so it might just trade a bit sideways. Now then for Yangtze Shipbuilding, I think it's doing a bit of a rebound. Overall, it's still quite weak. Yeah, since we're seeing a downtrend and since the breakdown of $2.24, but in the short term wise, some resistance around 208, 209, which is this horizontal resistance level as well as 10 MA today. Short-term support would come in, see at 194, 185 if let's see whether it can hold the 5 MA for now. So I think for now, probably just sideways consolidation. If it can form this, if it can hold the support at 5 MA, we might see some rebound again to try and test this 208. So we might just do a bit of sideways. Yeah, then below below 195, next support level will be closer to about 185 over here. So I think for now, probably quite sideways as well. Then other one is Rex. Yeah, for Rex, I think overall this one also quite similar in terms of the chart to Yangtze Shipbuilding, also quite weak. Seeing a bit of flattening for now. So I think some resistance will still hold for now horizontal wise around 0.105. Then in terms of the 10 MA today is 0.112, that's another resistance as well. And support probably around 0.09. So it might trade a bit sideways for now first. Yeah. Okay, then moving on to some of the Hong Kong counters, 9888 is Baidu. Yeah, so for Baidu, I think last week the sell down still holding the support around here, $75, and doing a bit of rebound, doing a bit of resistance at the 10 MA level. So that's close to about $84. So I think we might do a bit of slight pullback, but I expect support to hold around like around 79 to $80. This horizontal level as well as the 5 MA. So it might do a bit of pullback and do a bit of sideways between like 79 to 85 thereafter. And 9618 is Ping An, JD.com. So JD, Last week hold support at 127, doing a bit of rebound for now. But I think it's coming close to this strong support previously around 150 that will likely hold as a resistance. So 150 to 154, where this 20 MA is will be the resistance zone for now. Then I think short-term support could be looking at around 141 over here. Yeah, so you might do a bit of a sideways kind of trading as well. And then for Alibaba, I think for now probably in terms of bounce, the short-term resistance probably at 114, which was like a horizontal level swing high previously, as well as the current 10-day MA. Then support-wise could be the 105 for now. So might be in a bit of a range for now. Next resistance probably around 122, which is a gap fill as well as close to a horizontal level breakdown previously. So I think for now maybe just a bit of a sideways consolidation, which we normally see after a bit of a sell down and rebound thereafter. Then 2318, it's Ping An Insurance, also something quite similar. So rebound from support at around $40, currently reconnecting the 10-day MA resistance about $44, which was also near the highs of last Monday's sell down. So temporary resistance probably around there, support probably around 42 for now. Yeah, so we might just do some sideways over there. Then next resistance about 44, probably around 46, which is gap fill and support breakdown previously. So I think there's also a question on the Hang Seng Index. So I think it would be quite applicable to talk about it now also. So for Hang Seng, not sure why my lines are not showing. Yeah, okay. So for Hang Seng, there was a the Hang Seng there was the sell down last Monday actually brought it back down to this blue trendline support over here around 19.8K, then found support. Currently we are seeing a bit of a bounce. So I think for today, some short-term resistance probably around 21.5K, this 10 MA level. Might do a bit of pullback, but I think it could find a bit of support around 20.8K. This was a horizontal level resistance of last week, as well as the 5-day MA. So if you can hold a support over here to do continue a bit of higher low bounce over here, then we might see some further bounce ahead. Yeah, but for now, probably just a bit of probably a bit of a pullback from the current levels, then a bit of sideways first. If you can hold a higher low, then we might see some further rebound ahead. Okay, then there's also some questions on the three local banks, so I'll talk about it, as well as STI. Okay, perhaps I'll talk about STI first. Okay, so STI currently, I think it's currently doing a rebound from a strong support. So zoom back, since the 2020 bottom, yeah, the sell down actually took it back close to 3,400 about there, which was this channel support as well as the previous consolidation resistance. So currently doing a bit of rebound over here. I would say short-term resistance probably the highs of last week. On Thursday, probably around 3,640 about there. Where the 10 MA is currently down to could act as a bit of resistance. Then short-term support, I think for now, probably around 3,500. So you might just do a bit of a sideways currently for STI as well. Then for DBS, DBS, I think last week what I noticed was the 200 MA, this purple line was a resistance. So that was around $40. So 41, around 41.20 was also previous horizontal level there. Also a bit of resistance on the Thursday cap out. So for now, I think above 40 will still hold as a bit of resistance. Short-term support, I think probably we need to see try to hold this $38.30 level, this 5 MA level. Then we might see it stabilize a bit to do a bit of a sideways kind of price action going ahead. Then for UOB, I think also quite similar for the three banks. The 200 MA currently is a quite strong support around 34.40, which tested twice last week and unable to close above it. I think for now, we'll likely stay under it for now. short-term support I think that will hold is probably 32 to about 32.50 in this area. Then I think we might see a bit of sideways for now first. Yeah. And for OCBC, also can see the purple line 200 MA 1580, 1590 was a strong resistance. Then currently is doing a bit of sideways. So support for now probably around $15, about there. Yeah, then resistance probably 1580, 1590 over here. So we might see a bit of sideways as well. So I think in general for the in terms of both Hong Kong and Singapore indices as well as most individual those blue chip components we could see a bit of sideways because after a sell down then we have a bit of rebound. And usually after a bit of rebound then we could see a bit of a lower volume kind of sideways consolidation first as the market awaits the next move. And so that's my take on it. And so I think it's about there's still quite a lot of TA questions, sorry. I think I'll be unable to take all of them, but feel free to post them in our Poem 3 community TA group. Yeah, then I can answer them over there. Yeah, so sorry about that. Maybe I hand time back to some of the other colleagues if they have anything to add on for today's webinar. Thanks. Okay, I think they have nothing more to add on. I think that's it for today's session. So thanks. I'd like to, on behalf of my team, I'd like to thank everyone for your questions as well as your kind attendance. Sorry, I'm unable to take all your questions, especially for the TA, but feel free to post them in our P3 community group. I'll take over from there. And also feel free to join our corporate insights webinars. As well, for example, this Wednesday noon we have VinFast. So feel free to join if you are free, and we hope to see you again next week. Yeah, so have a great week ahead, and we see you again. Yeah, thanks and bye bye.